xAI just quietly turned itself into a property rental company, and nobody really noticed. Here's the bombshell. Elon Musk's AI lab, which was supposed to be competing with OpenAI and DeepSeek for the next generation of frontier models, is now generating revenue by renting out expensive GPU clusters to other companies. That's not what a research lab does. That's what a real estate investment trust does. Think of it like this. Imagine you opened a restaurant to create the world's best cuisine, but after a year, you realized the real money was leasing out your kitchen to other chefs instead of serving your own dishes. That's essentially what's happening here. xAI built massive data centers with hundreds of millions of dollars in compute capacity. But instead of pouring all that power into training the next breakthrough AI model, they are monetizing it by selling access. This change tells us something profound about the current state of artificial intelligence, and it's not what the headlines are saying. The real story isn't about xAI becoming a rental company. It's about what this reveals regarding the entire structure of the AI industry right now. When a company with Elon Musk's resources and ambition pivots from research to infrastructure, it's a signal, and that signal is loud. This is where it gets interesting, because this decision exposes a massive miscalculation in how people have been thinking about AI competition. Let's rewind. xAI launched in 2023 with enormous fanfare and Musk's personal credibility behind it. The stated mission was clear: build an AI system that understood the world better than existing models. They hired top researchers, assembled world-class talent, and positioned themselves as a direct challenger to OpenAI and Google's DeepSeek and other frontier labs. For about 2 years, that narrative held. xAI released Grok, their conversational AI model integrated with X's platform. It was competitive, but it wasn't revolutionary. Meanwhile, something else was happening in the background that changed everything. The infrastructure arms race accelerated dramatically. Every AI company needed massive computing power. OpenAI needed it. Anthropic needed it. Google needed it. And suddenly, the bottleneck wasn't talent or algorithms anymore. It was raw hardware. Specifically, NVIDIA H100 and H200 GPUs, which cost roughly $40,000 each and are almost impossible to get. xAI, meanwhile, had invested heavily in building data centers and acquiring these chips, thousands of them. So here's the realization that hit. Why spend $500 million training proprietary models when you can spend $500 million building infrastructure and rent it out for recurring revenue? The math is seductive. Data center business models generate predictable cash flow. Model businesses are unpredictable. You need to beat competitors repeatedly. And this is where the change becomes visible. Here's what xAI's rental model actually looks like in practice. They own or control massive compute infrastructure. We are talking potentially 100,000 or more GPUs spread across multiple locations. Instead of using all that capacity to run their own AI training, they lease it to customers. A company wants to fine-tune an AI model. They rent GPU time from xAI. A startup needs compute power for inference, running a trained model to produce outputs. Rent from xAI. This is basically Amazon Web Services logic applied to AI infrastructure, and it's genuinely profitable. Here's why. If you own 100,000 GPUs and you can rent them at a utilization rate of 70%, that's fairly standard for cloud infrastructure. You're generating revenue constantly. Let's do the math. A single H100 GPU costs roughly $40,000 to purchase, but might generate $3,000 per month in rental revenue. That's a 9-month payback period on the hardware investment, and then the rest is profit. Scale that to 100,000 GPUs, and you're looking at $300 million monthly in potential revenue. That's the appeal. But here's the complexity. Infrastructure margins are typically 30 to 40% after operational costs like power, cooling, and networking. That still leaves real money, but it requires constant capacity management. You can't leave GPUs sitting idle. You need to keep them rented or you hemorrhage cash. This is very different from building world-leading AI models where you only need to win once. Timing of xAI's pivot is critical, and it reveals something the industry has been avoiding. Frontier AI research is getting harder and more expensive. OpenAI spent roughly $50 to $100 million to train GPT-4, Training the next generation models is going to cost multiples of that, potentially in the billions. DeepSeek and other competitors have proven that you don't need to be in Silicon Valley to build competitive models anymore. That advantage, if it ever existed, is eroding. So what do you actually own as a moat in 2026? Two things. Either you build dramatically better models, which is getting harder and more expensive, or you own infrastructure that everybody else needs. xAI looked at that landscape and chose the second path, and they're not alone in this thinking. Look at what's happening elsewhere. Grok, a startup that built custom AI chips, is positioning itself as infrastructure. CoreWeave, which specializes in GPU, cloud compute, is growing explosively because demand for rental capacity outpaces supply. Even tech giants like Amazon and Microsoft are betting massive amounts on infrastructure control rather than trying to out-research each other. Here's the uncomfortable reality for pure research labs. Infrastructure is less risky. You have predictable revenue. You have a moat that's harder to disrupt than a software model. Hardware takes years and billions to replicate. And most importantly, if you own the infrastructure that powers AI, you win regardless of whose models run on top of it. So xAI's pivot makes business sense, even if it's philosophically jarring. This change tells us something uncomfortable about the current state of AI competition. If xAI, backed by Elon Musk's resources and credibility, is pivoting away from frontier research, what does that signal about how winnable that game actually is? The honest answer is, it's become extremely difficult to differentiate on models alone. Here's the brutal comparison. In 2022 and 2023, the narrative was that AI leadership would be determined by who built the best large language models. OpenAI had GPT, Google had Gemini, Meta had Llama, xAI had Grok. But in 2024 and 2025, we've seen that narrative completely invert. OpenAI is now positioning itself as an infrastructure and services company. DeepSeek proved that Chinese teams with different economics could build competitive models. Smaller labs like Anthropic are focusing on specialized models rather than competing for overall supremacy. The game has shifted from being about model superiority to being about access, and access is determined by infrastructure control. Think of it like the difference between owning a restaurant versus owning the supply chain that feeds every restaurant. The restaurant is more glamorous, but the supply chain makes more money and has more defensibility. xAI looked at this realization and chose the supply chain. Now, this doesn't mean xAI abandoned model building entirely. They'll continue developing Grok and other systems, but the center of gravity in how the company thinks about itself has shifted. The priority revenue stream is now infrastructure. And when you prioritize infrastructure, your business goals change in fundamental ways. Here's what this means for you and for the broader AI ecosystem. First, pricing. If xAI and other infrastructure companies are going to compete on capacity rental, that drives prices down over time. That's good for anyone trying to build or run AI systems. Costs become more accessible. But there's a catch. Whoever owns the infrastructure has immense leverage. If xAI controls a significant percentage of GPU rental capacity, they can influence who gets compute power, how much they pay, and on what terms. That's a different kind of power than building the best model. Second, innovation speed. Companies that depend on renting compute capacity from xAI or similar vendors are now dependent on third-party infrastructure. That's less risky than building your own data centers, but it also means your fate is partially tied to their priorities and their uptime. If xAI experiences a major outage, every company renting from them is affected. Third, consolidation. The move toward infrastructure as business is going to favor the companies with the deepest capital reserves. xAI can weather periods of lower utilization because Musk's capital backing is essentially unlimited. Smaller startups can't. Over the next 5 to 10 years, expect massive consolidation in the GPU rental space. The companies that survive will be the ones that can build scale efficiently and maintain capacity in a capital-intensive business. And fourth, geopolitics. Infrastructure ownership is increasingly a matter of national competition. The United States, the European Union, and China are all racing to build domestic AI infrastructure capacity. When xAI rents GPU to customers. It's also determining which nations and companies have access to frontier computing capabilities. That has political implications we are still working through. So if you're watching the AI industry and trying to understand where real value is being created, here's what to pay attention to going forward. First, monitor utilization rates and pricing. When xAI reports or hints at their data center utilization rates, that tells you whether their infrastructure strategy is actually working. If they are running at 60% utilization or lower, that's a warning sign. It means they're not generating expected revenue. If they are above 80% consistently, that's a profitable model. Track pricing for GPU rental across competitors, xAI, CoreWeave, Lambda Labs, and others. As more players enter the market, prices will normalize, and that competition will reveal who has built the most efficient infrastructure. Second, pay attention to capital expenditure announcements. xAI will likely need to continue massive investments in data centers to stay competitive. When they announce new facilities or major hardware purchases, that's a signal of confidence in the rental business. But it's also a signal of capital intensity. They're betting billions that this will work. Third, look at who's using their rental services. Are major AI companies leasing from xAI? Are startups? Are researchers? That customer base tells you whether xAI's infrastructure offering is actually compelling to the market or if it's struggling to find demand. Fourth, watch model development. Even though xAI is pivoting to infrastructure, they haven't abandoned Grok. If Grok stagnates while competitors improve rapidly, that's evidence that prioritizing infrastructure over research was the wrong call. Conversely, if Grok continues improving, it shows they can do both. And finally, track regulatory developments. As infrastructure companies like xAI gain more control over AI capacity, regulators are going to become increasingly interested. Antitrust, export controls, and compute allocation are all going to be policy battlegrounds in the next few years. Here's what you need to take away from xAI's pivot into infrastructure. The AI industry is undergoing a fundamental structural change. The companies that win in the next 5 years might not be the ones that build the best models. They'll be the ones that control the infrastructure those models run on. xAI saw this future clearly and moved to position themselves within it. It's a pragmatic decision. It's also a signal that frontier AI research has become so capital-intensive and difficult to differentiate that owning the hardware everyone needs is a more stable business than competing for marginal improvements in model capability. That doesn't mean research stops, it continues. But the center of gravity is shifting. This has major implications for pricing, for access, for geopolitics, and for which companies end up dominating the AI landscape. The companies that understand this change, that infrastructure is the new moat, will thrive. The companies that keep believing the story about model supremacy and pure research advantage are going to find themselves increasingly dependent on renting capacity from companies like xAI. Watch the next 12 months carefully. If xAI's infrastructure strategy succeeds, if their data centers are running hot at high utilization and they're generating serious revenue, expect every other major AI player to make similar moves. We're potentially looking at a future where the real AI economy isn't about who built the smartest model, but who owns the most GPUs and charges the best price for access. That future might already be here. If you want to stay sharp on these trends, follow for daily AI news and hit that subscribe button. We are breaking down these changes as they happen so you understand where the actual power in AI is consolidating.